Welcome to Goldmine Investing, your one-stop channel dedicated to guiding you through the golden opportunities in the world of gold investing. Gold, an element as old as civilization itself, has been a symbol of wealth and prosperity for millennia. But how does one turn this shiny metal into a profitable investment? That's where we come in. Our mission is to equip you with the essentials, understanding the reasons to invest in gold, getting to know the different types of gold investments, dissecting the factors that influence gold prices, and most importantly, acquainting you with the key acronyms, regulations, and fundamentals associated with the gold market. These are the foundation stones of your gold investing journey. Familiarizing yourself with these concepts, you'll be able to navigate the complexities of the gold market with confidence, and make informed decisions to dive into the world of gold investing. Why should you consider gold as part of your investment portfolio? Such a question has been asked by investors for centuries and for good reason. Gold, a precious metal that has been valued by civilizations throughout history, continues to hold an esteemed place in today's financial world. One compelling reason to invest in gold is its enduring value. Unlike paper currency, coins, or other assets, gold has maintained its worth throughout the ages, often serving as a safe harbor during times of economic uncertainty. This is because gold is not directly affected by the same factors that influence the value of traditional assets such as stocks or bonds. Instead, its value is largely based on perception and sentiment, making gold a reliable store of value. In addition to its historical significance, gold is also seen as a hedge against inflation. In periods of high inflation, when the cost of goods and services increases, the value of gold tends to rise. This is because as the value of paper currency diminishes, more investors turn to gold as a means of preserving their wealth. Consequently, gold can be a powerful tool for protecting one's purchasing power in times of economic instability. Another reason to invest in gold is its potential for growth. The value of gold can increase over time, providing investors with the opportunity for capital appreciation. This is especially true during times when demand for gold outstrips supply, such as during periods of geopolitical tension or financial crisis. Moreover, as emerging markets continue to grow and develop, the demand for gold both for investment and for use in jewelry and technology is expected to rise, potentially driving prices even higher. So, gold can be a valuable asset in your investment portfolio. But how can you invest in it? Well, there are several ways to add gold to your investment mix, each with its own set of advantages and disadvantages. But before we delve into the specifics of gold investments, it's essential to understand the dynamics of gold prices and familiarize yourself with the key acronyms, regulations, and fundamentals of the gold market. By doing so, you'll be better equipped to navigate the complexities of gold investing and make informed decisions that align with your financial goals. There are several ways to invest in gold. First up is physical gold. This is the most traditional way to invest, and it involves buying gold in the form of bars, coins, or jewelry. It's tangible. You can hold it in your hands and it has intrinsic value. However, keep in mind that storage and insurance can be a concern. Secondly, there are gold exchange-traded funds or ETFs. These are investment funds traded on stock exchanges. Gold ETFs, such as the Spider Gold Shares GLD, allow you to gain exposure to gold prices without physically owning the metal. The upside is that it's easy to buy and sell, but the downside is that you don't actually own the gold. Next, we have gold individual retirement accounts or gold IRAs. These are retirement accounts that allow you to hold physical gold. They offer tax-deferred growth, meaning you won't pay taxes on your gains until you start taking distributions. However, the IRAs have strict rules on what kind of gold can be included, and there are additional costs for storage and management. Then there are gold mining stocks. These are shares in companies that mine for gold. The advantage is that if the company does well, you could see significant returns. However, it's also risky as you're not just betting on the price of gold, but also on the success of the mining company. Finally, you can also invest in gold futures contracts on the Commodity Exchange Inc. or COMEX. This is a more advanced method as it involves speculating on the future price of gold. It can lead to high returns, but it's also highly risky and not recommended for beginners. Now that you know the ways to invest in gold, let's understand how to gauge the gold market. Remember, each type of gold investment comes with its own set of advantages and disadvantages. It's crucial to do your research, understand what you're getting into, and consider how it fits into your overall investment strategy before diving in. Understanding gold prices is key to successful investing. Now let's dive into the factors that influence these prices. First up is supply and demand dynamics. When the demand for gold, driven by jewelry, investment, and central bank purchases, exceeds its supply from mining and recycling, prices tend to rise. Next, we have gold's role as an inflation hedge. In times of currency depreciation and rising prices, gold preserves its purchasing power, often leading to increased demand and higher prices. Then, consider gold as a safe haven asset during economic uncertainty, geopolitical tensions, or market volatility. Investors flock to gold for stability and wealth preservation, pushing its price up. Lastly, let's touch on currency correlations. Gold often has an inverse relationship with the US dollar. When the dollar weakens, gold priced in dollars becomes more attractive to investors, and its price typically increases. Gold prices can fluctuate, but being aware of these factors can help you make informed decisions. Before diving into gold investing, you need to familiarize yourself with some key terms and regulations. First, let's take a look at some essential acronyms. ETF, or Exchange Traded Fund, is a type of investment fund and exchange-traded product that allows investors to gain exposure to gold without physically owning the metal. Next, we have IRA, or Individual Retirement Account, which is a tax-advantaged account that can hold various assets, including physical gold. Speaking of gold, GLD is the acronym for Spider Gold Shares, one of the largest and most popular gold ETFs. In the world of gold trading, LBMA, or the London Bullion Market Association, sets crucial global standards. Lastly, COMEX, the Commodity Exchange Inc., is a leading commodities exchange where gold futures contracts are traded. Now, let's touch on regulations. Securities and Exchange Commission, or SEC regulations, govern the trading of gold-related securities to protect investors and maintain market integrity. Then we have IRS, or Internal Revenue Service, regulations that outline the tax implications related to gold investments. There are also mining regulations, which vary by jurisdiction and govern gold exploration, mining operations, environmental compliance, and mineral rights. Finally, let's talk about some key fundamentals. One of the most crucial aspects to understand is the supply and demand dynamics. The balance between gold supply from mining production and scrap recycling, and demand from jewelry, investment, and central bank purchases influences gold prices. Gold is often viewed as a hedge against inflation, preserving purchasing power during periods of currency depreciation and rising prices. It also serves as a safe haven asset during times of economic uncertainty, geopolitical tensions, or market volatility. Gold typically exhibits an inverse correlation with the US dollar and other fiat currencies, as it is often priced in dollars and serves as an alternative store of value. Lastly, interest rate policies set by central banks can impact gold prices. Lower interest rates tend to support gold demand as the opportunity cost of holding non-interest-bearing assets decreases. By understanding these acronyms, regulations, and fundamentals, you can navigate the complexities of the gold market with greater confidence. It's like learning a new language. But instead of helping you in a new country, it helps you in the land of gold investing, making you more fluent in the language of gold. And that's it for today's lesson on key acronyms, regulations, and fundamentals in gold investing. Remember, knowledge is power, and the more you understand about the gold market, the better equipped you'll be to make informed investment decisions. So, keep educating yourself, stay curious, and you'll soon be navigating the golden landscape like a pro. So, are you ready to embark on your gold investing journey? We've explored that investing in gold is not just about buying a shiny metal. It's about understanding key acronyms like ETF, IRAs, GLD, LBMA, and COMEX. It's about navigating regulations set by the SEC, IRS, and various mining authorities. It's about grasping the fundamentals that drive the gold market, from supply and demand dynamics to inflation hedging, from the role of gold as a safe haven asset to its correlation with currencies and interest rates. But don't be daunted. Goldmine Investing is here to guide you through this labyrinth of information, to break down the intricate world of gold investing, making it accessible and comprehensible so you can make informed decisions and grow your wealth confidently. Subscribe to Goldmine Investing for more content on investing in your gold investing journey today.